with you a trade entry that I got into on Friday, the reason I got into the trade, and my exit position as well. So right here, we're currently on the 4-hour time frame, and as you can see that right here, price created a 4-hour high and a low right here. Overall, this is our overall swing low and overall swing high. So we're currently in this range, and as you can see right here, within this range, low, range, high, you can see that price created a low, created a high, and then right here drop down, breaking the structure. This was the last move to the upside. Price came into it, mitigated it, dropped to the downside. We had another impulsive move to the upside, drop down, breaking this low. And then now, if we were to go bullish, I would have loved price to break this high right here and close above it. But as you can see, we didn't break it. We ran liquidity from the high and then drop down, breaking this structure. So all I was looking for to see right here was a 15-minute shift in market structure. So if we go to the 15 minutes time frame, you can see very clearly on the 15 minutes time frame that after we took liquidity from that 4-hour high, we broke a 15 minutes low. So I'm going to show you that shortly. So right here, this right here was the 4-hour high, and this right here was the 15 minutes low. And as you can see, after we took that 4-hour high resting right here, the moment we took it, price dropped down, then ran liquidity from here, had this impulsive move, drop down, breaking the structure. So basically what I'm looking for to see in the market is for price to run the low and close below it. If we don't close below it, I do not see that as a break of structure because it's a potential run on liquidity. So that is why here we ran liquidity from the previous low, then had this impulsive move and then drop down, breaking the structure. So this right here becomes my key level, but I'm anticipating to see the buy side liquidity resting right here to get taken. Now, if we go back to the 4-hour time frame, so on the 4-hour time frame, you're gonna see the buy side liquidity a little bit more clearer because right here we have an inefficiency, and right here was the buy side liquidity. And as you can see, price took that liquidity, and after taking the liquidity, the next thing we saw, the next thing I wanted to see from this key level was a 15-minute shift to market structure. So we'll go to 15 minutes time frame. So on 15 minutes time frame, even on 30 minutes time frame, it's quite evident right here, the low, the high. But basically what I do is, if my point of interest is a 4-hour time frame, I'm waiting for a 15-minute shift in market structure. It's really very simple. If the point of interest is 4-hour time frame, I count 3 time frames to the left, 1, 2, 3, and then that is the key level I'm waiting for price to break. And right here we'll have a 15 minutes low, 15 minutes high, and then this low eventually got broken. The moment this low got broken, now this last impulsive move to the upside was the first entry into the marketplace. And then another thing I did was as well to wait for price to run this low. So the first entry was right here. Right here was the first entry. Stop loss above this high. So I always prefer to use the previous high or previous low as my stop loss. I never try to put my stop loss above this highs because anything can happen and price could potentially run that liquidity and then still go towards the direction. Because you can see that if you had your stop loss resting right here, slippage might actually even take you out of this trade and then price will go towards the direction. So I basically always leave my stop loss above this high and then look for the nearest inefficiency like this key level right here. But I never look for a 1:1 or 1:1.5. The minimum I'm looking for in the marketplace is a 1:2. So what I did after price broke this structural low right here on the 15 minutes time frame, what I did was to wait right here to see a potential shift in market structure on the 3 minutes time frame. So as you can see right here, after price tapped into that key level, so you can basically use either a 5 minutes or a 3 minutes shift in market structure. But I'm going to show you what I actually did to get into this trade to deliver the 1:4 risk to reward ratio. So the moment price tapped into that key level, the moment price tapped into this key level right here, this is my low, this is my high. All I wanted to see was this low get broken, and as you can see, price drop down, breaking this low. Now this inefficiency right here is my entry position into the market. I'm also going to show you another added confidence that I used in placing my limit order right here and my stop loss resting above this high. You can see right here This is my entry. This was the entry into the market. This right here is my stop loss. The reason I used here as my stop loss was because I already have seen the shift in market structure right here. So the moment I saw the shift in market structure, as long as we're going to remain bearish and run the sell side liquidity, I would like this high to stay sustained. And that is the reason why you can see even price came very close, dropped, and then 130 New York, which was 830 New York, 130 London, which was 830 New York. We saw this spike to the upside, activated me, and ran straight to my take profit position. Now, the reason my take profit is here is because of this inefficiency, and as you can see, this inefficiency as well is my drawn liquidity. I was anticipating for price to draw into that key level. That is the reason why my take profit position is right here. But I never like to put my take profit exactly at that point because sometimes price can come very close to it and reverse. So I like to give it a little room to just run straight to my take profit. And as you can also see right here, even when we came to the take profit, we had this rejection and then slam through it. So I'm going to show you another added confluence that I used as well in placing my limit order right there. This is also going to be a game changer for a lot of new people that are still struggling with finding consistency. So what I did was the overall 15-minute structure. So I was working with the overall 15-minute structure being the 15 minutes low and the 15 minutes high. So this right here, I'm going to take it off. I used my Fibonacci right here. I placed it from this low and then to this high. Now I'm going to make it a little bit darker color. So I placed it to that high. So I'm going to make it red. So right here, this right here, let me make it purple so it's very different from everything else in the chart. So right here is my extreme premium zone. Right here is my extreme discount zone. And right here is my equilibrium. So here is discounts and everything above the equilibrium is premium, but this is extreme premium, this is extreme discount. So what I did was I looked for the key level resting at the extreme premium level. So as you can see, this is the extreme premium level. And what do you see right there? An inefficiency, which is going to be a draw on liquidity to attract price to the upside. And then my take profit position, an extreme discount key level. And what's resting at the extreme discount key level? Inefficiency, the close of the inefficiency. So if you want to learn more how to do this independently, I created a very amazing course. You go through that course and you will learn how you can do this. And even if you're holding down a full-time job, you can still do this independently after watching my course. I'll see you on the other side.